Bitcoin just bounced back $8,000 in a single day. Right now it's sitting at 68,605. And if you're looking at that thinking, phew, crisis averted, time to buy, I need you to stop. Because what I'm about to show you suggests this recovery might be the eye of the storm, not the end of it. The data coming out from VanEck, Goldman Sachs, and on-chain analysts is painting a very different picture than what you see on your price chart. And if you don't understand what orderly deleveraging actually means, you could be walking straight into the next leg down. In this video, I'm going to break down exactly what's happening beneath the surface of this bounce. I'll show you the 3 critical indicators that suggest Bitcoin could still drop to $50,000. I'll explain why VanEck is calling this a 6.005 sigma event, one of the fastest crashes in crypto history, and why that matters for what comes next. And most importantly, I'll show you the exact date you need to be watching, February 20th, because that's when everything could change. If you want to understand what's really happening in Bitcoin right now, not just react to price moves, hit subscribe. Let's get into it. All right, let's set the scene. Bitcoin hit an all-time high of $126,080 back in October 2025. Since then, it's been sliding. 4 months of slow grinding decline. Then, on February 5th, it crashed hard. Bitcoin dropped from the mid-70,000s down to 60,057 in a single session. That's 13% in one day. Goldman Sachs came out and called it a 3.5 to 6 sigma event. For those who don't speak statistics, that's a move that has a 0.05% chance of happening. Basically, it's not supposed to exist. VanEck went even further. They calculated it as a 6.05 sigma move on the rate of change Z-score, placing it among the 15 fastest single-day crashes in crypto history. Now here's what's strange. After that brutal crash, Bitcoin bounced. It recovered to around $71,000 briefly, and now it's stabilized around 68,605. Most people see that bounce and think, okay, the worst is over. We hit bottom. Time to accumulate. But that's not what the data says. Here's the phrase everyone's using: orderly deleveraging. VanEck said it. Galaxy Digital said it. Every major crypto analyst is using this term. And if you don't understand what it actually means, you're missing the entire story. Let me explain. Deleveraging is when traders who borrowed money to buy Bitcoin are forced to close their positions. They have to sell, not because they want to, because they have no choice. Margin calls, liquidations, forced exits. Now, deleveraging can happen 2 ways. 1, disorderly. That's panic. That's cascading liquidations where the price free falls and nobody can get out. Think Luna, think FTX. That's disorderly. 2, orderly. That's when positions unwind in a controlled way. Prices fall, but they fall steadily. Leverage comes down gradually. The system doesn't break. What we just saw, VanEck and Galaxy both say it was orderly deleveraging. Now most people hear orderly and think safe. They think it means the danger is over. But here's what they're missing. Orderly deleveraging doesn't mean the deleveraging is done. It just means it hasn't panicked yet. And the data shows we're only halfway through. Let me walk you through the 3 critical indicators that suggest this isn't over. Bitcoin futures open interest, the total value of outstanding contracts, fell over 20% in a single week. At the peak, we had around $815 billion globally. Now, we're at $638 billion. That's a 21.7% drop. That's one of the largest deleveraging events since the March 2023 banking crisis. Now here's the key. When open interest falls but the price stabilizes, it means speculative excess is being removed. That's good long term. But short term, it tells you that Bitcoin's price support wasn't coming from real demand. It was coming from leverage. And when leverage is gone, price needs to find a new equilibrium. And that new equilibrium might be lower. BlackRock's IBIT saw $641 million in net outflows over 10 days. The entire Bitcoin ETF complex posted $5.7 billion in outflows between November 2025 and January 2026. Now, institutions aren't panic selling, but they are risk reducing. Goldman Sachs cut its Bitcoin ETF holdings by 39.4% in Q4. That's not fear, that's strategy. And here's what that tells you. The institutional bid that everyone thought was permanent, it's conditional. When risk-off sentiment dominates, institutions pull back, and they're pulling back right now. CME basis trade. Unwinding. This one's technical, but stay with me because it matters. The CME basis trade is when big players buy spot Bitcoin through ETFs and short CME futures to capture the spread. It's supposed to be low risk, market neutral, but when risk managers say degross everything, even these hedge positions have to unwind. Look at what happened. The near-dated basis jumped from 3.3% to 9% in a single day. That's one of the biggest moves since ETFs launched. That tells you funds like Millennium and Citadel were forced to exit positions they didn't want to exit. And when that happens, selling pressure doesn't come from fear, it comes from mechanics, from math. And that math isn't done yet. Now let me explain why this current bounce to $68,605 might actually be setting up the next leg down. After violent crashes, markets often bounce. It's called a relief rally. Shorts cover, dip buyers step in. The price recovers 10-15%, but that doesn't mean the trend has reversed. It just means the immediate panic subsided. Here's what typically happens in orderly deleveraging phases. Phase 1 is the break. Key levels fail. Liquidations begin. Market depth thins. That was February 5th. Phase 2 is the cascade. Forced sellers dominate. Correlated assets fall together. Bitcoin, stocks, everything drops. That was the dip to 60K. Phase 3 is the relief bounce. Shorts cover. Buyers step in, volatility stays high, but price recovers. That's where we are now. Phase 4 is the retest. After the bounce, the market retests support. If that support fails, the next leg down begins. We're in Phase 3 right now, and everyone's treating this like Phase 4 already passed, but it hasn't. The question isn't, did we bottom? The question is, will $67,000 hold when we retest? And the data suggests it might not. Let me show you why analysts are warning about a potential drop to $50,000. First, look at the technical structure. Bitcoin is trapped in a descending channel. Resistance sits at $71,600. Support is at $67,172. Right now, we're right in the middle at $68,655. If Bitcoin fails to break above $71,600 and close there on a daily basis, the next move is likely down. Second, the 4-year halving cycle is still intact. Despite all the institutional adoption, despite the ETFs, Bitcoin is still following its historical pattern. And that pattern suggests a potential summer 2026 low before the next major rally. Third, mining dynamics are about to shift. On February 20th, we have a mining difficulty adjustment coming. If the hash rate rises but the price doesn't, some miners will capitulate. And miner capitulation often marks local bottoms, but it also creates short-term selling pressure. Now, I'm not saying Bitcoin is definitely going to $50,000. What I'm saying is the probability is higher than most people think. The market structure is fragile. Leverage is still being removed. Institutional flows are weak, and we haven't retested the lows yet. Now, here's the part that's actually fascinating about this whole situation. This isn't 2018. This isn't 2022. This is a completely different market structure. In 2018, when Bitcoin crashed, it was crypto native. Retail got wiped out. Exchanges collapsed. Projects died. It was brutal, but it was contained within crypto. In 2022, we had leverage, but we also had fraud. Luna, FTX, Three Arrows Capital. Those were systemic failures. But 2026, this is different. Bitcoin is now integrated into the traditional financial system. It trades inside institutional portfolios alongside software stocks, tech equities, growth plays. It's governed by the same risk managers, subject to the same margin rules. And that changes everything. When Goldman tells risk managers to degross, Bitcoin gets sold. Not because Bitcoin is bad, but because it's in the same book as everything else getting sold. Bitcoin's correlation with software stocks over the past month, nearly perfect lockstep, but its correlation with gold, much weaker. Why? Because gold doesn't sit inside multi-strategy hedge fund portfolios. Bitcoin does, and that means Bitcoin now moves based on institutional positioning, not just crypto sentiment. Let me show you something that almost nobody is talking about: the liquidity problem. Reuters reported that Bitcoin's average market depth, the amount of liquidity sitting 1% away from the current price, has dropped from $8 million in 2025 to $5 million now. That's a 37.5% reduction in liquidity. Now, $5 million doesn't sound like no liquidity, but it's the difference between an orderly pullback and a disorderly air pocket. When a big sell order hits a thin book, the price gaps down hard. And when that happens, it triggers stop losses, which triggers more selling, which creates a cascade. That's what happened on February 5th. And the liquidity hasn't improved since then. As long as liquidity stays thin, Bitcoin remains vulnerable to sudden moves, both directions. But right now, the path of least resistance is down. Now, let's zoom out for a second and talk about the macro environment, because that's what's really driving this. The Fed is in a tough spot. Inflation cooled to 2.4% in January 2026. That's good. But labor markets are still tight. Economic data is mixed. And here's what matters for Bitcoin. The market is pricing in uncertainty about what the Fed does next. If the Fed signals tighter policy for longer, risk assets get hit. Bitcoin gets hit. If the Fed signals they're done, risk appetite comes back. Bitcoin rallies. But right now, we're in limbo, and markets hate limbo. On top of that, Kevin Warsh's nomination to the Fed is creating additional uncertainty. Warsh is known for hawkish views on inflation. His confirmation could signal tighter financial conditions ahead. That matters because Bitcoin trades as a risk asset now. When financial conditions tighten, Bitcoin suffers. All right, so I've given you all the bearish data, but let me give you the contrarian case because it's important to see both sides. First side is that forced liquidations are moderating. The massive liquidation waves we saw on February 5th and in the days following, they're slowing down. When forced selling subsides, it means price can stabilize. And if it stabilizes above $60,000, that becomes the new support. Second side is that on-chain data shows accumulation. Wallets accumulated 387,930 BTC over 30 days. That's massive. Long-term holders aren't selling. In fact, through the entire crash, long-term holder supply didn't budge. They're riding this out. Third side shows the absorption problem might actually be setting up the next rally. Yes, $308 billion flowed into Bitcoin in 2025 while market cap declined. That means sellers absorbed all that demand. But here's the thing. At some point, sellers run out. And when they do, all that pent-up demand hits a supply wall. That's when explosive moves happen. Fourth, sentiment is at maximum pessimism. And historically, that's when you buy. Sentiment tracks social media sentiment. Right now, bearish sentiment on Bitcoin is at levels not seen since 2022. Everyone thinks it's going lower. And when everyone thinks something, the market usually does the opposite. Now here's the date you need to watch, February 20th. That's when the next Bitcoin mining difficulty adjustment hits. Here's why that matters. After the crash to 60K, some miners shut down. The global hash rate dipped 20% due to winter weather and low profitability, but it's recovered to 1.0, 1.2 ZHS. If the difficulty increases on February 20th, that means more miners are coming online. That's bullish long term. It shows network security is strong. But short term? If difficulty rises but price doesn't, miners face a profitability squeeze. And when miners can't cover costs, they sell Bitcoin to pay bills. Miner capitulation often marks local bottoms. But it also creates selling pressure right before the bottom forms. So February 20th could be the trigger for one final flush down. Or it could be the confirmation that the worst is over. Either way, that's the date to watch. All right, so what do you actually do with all this information? First, don't try to time the bottom. If you're a long-term holder, this changes nothing. Bitcoin's long-term trajectory is intact. Accumulate on weakness if you believe in the thesis. Second, if you're trading, wait for confirmation. A daily close above $71,600 would signal the downtrend is breaking. Until then, assume downside risk remains. Third, watch $67,000 like a hawk. That's the critical support. If Bitcoin retests and holds, we're likely building a base. If it breaks, $63,900 is the next target with $60,000 below that. Fourth, don't underestimate the power of sentiment. When fear is maximum, opportunity emerges. But timing is everything. Wait for the data to confirm. And fifth, keep cash on the sidelines. If we do get a final flush to $50,000, $60,000, that's where the real opportunity is. Don't blow your entire position chasing this bounce. Let me zoom out and give you the big picture here. Bitcoin has corrected roughly 45% from its all-time high of $126,080 to the low of $60,057. Now it's recovered to $68,605. In the context of Bitcoin's history, this is normal. 2017-2018 saw an 83% drawdown. 2021-2022 saw a 77% drawdown. So far, 2025-2026 is only down 52% from peak to current. That's actually mild compared to previous bear markets. But here's the key difference. This isn't a bear market. This is a correction within a bull market. The halving cycle suggests we're still in the upward phase. The institutional infrastructure is stronger than ever. The regulatory environment is improving. The US administration is pro-Bitcoin. All of that is still intact. What we're seeing right now is a leverage flush, a deleveraging event, a reset of positioning. And when those resets complete, the next move up tends to be violent. But you have to survive the reset first. All right, let me bring this home. Bitcoin just recovered to 68,605 after nearly breaking $60,000. That looks like strength. But the data underneath tells a different story. This is orderly deleveraging. That means it's controlled, but it's not done. Futures open interest is down 21.7%. ETF outflows are accelerating. The CME basis trade is unwinding, liquidity is thin, and we haven't retested the lows yet. Analysts are warning about a potential drop to $50,000 by summer 2026. Not because Bitcoin is broken, but because the market structure needs to fully reset. The date to watch is February 20th. That's when the mining difficulty adjustment hits. That could be the catalyst for one final flush or the confirmation that we've bottomed. Here's your action plan. If you're long-term, stay patient. This changes nothing about Bitcoin's 2030 outlook. If you're trading, wait for $71,600 to break and hold before going long. Watch $67,000 support. That's the line in the sand. Keep dry powder. If we flush to $50,000, $60,000, that's the opportunity. Don't fight the trend until the trend confirms it's broken. This bounce might be real, or it might be a trap. The data will tell us. But right now, the data says stay cautious. Now, there's one thing I didn't cover in this video. How the Strategic Bitcoin Reserve Executive Order and the new regulatory environment could change Bitcoin's trajectory completely. That's a whole separate analysis. If you want me to make that video, drop a comment below and let me know. Also, where do you think Bitcoin goes from here? 50K, 70K, 100K? Let me know your prediction. And if this video helped you understand what's really happening beyond just the price chart, hit that subscribe button right now, because the next few weeks are going to be wild and you're going to want to stay informed. I'll see you in the next one.